This video is in high demand. We have 2 people asking for it. And I give the people what they want. We're bringing you guys this video, how to make your own ETF portfolio. Let's get into it. Okay, so the first thing we're going to discuss is active versus passive investing. So passive investing is when you buy into ETFs, index funds, or mutual funds. A simple way to explain ETFs, index funds, and mutual funds, it's essentially a basket of stocks. So you make one purchase and you get access to multiple different companies and potentially a whole stock market. Depending on your goals, you choose different ETFs that you want to include in your own portfolio. With passive investing, you're investing in ETFs and index funds that track the whole market. So to make this a bit more clear, if you were to buy an ETF that tracks the S&P 500, you would essentially get the returns of the S&P 500 because the ETF you're buying holds all the companies in the S&P 500. Active investing is trying to pick individual stocks that you believe will outperform the market. There is no guarantee that the stocks you pick will actually outperform the market, but there is the potential to outperform the market. It is often referred to as a loser's game because majority of people will lose in trying to beat the markets. Even the professional managers can't beat the market. After 10 years, almost 82% of mutual fund managers failed to beat the market, and after 15 years, 92% failed to beat the market. So it's extremely hard to actually pick an active manager that will beat the market. So the best thing that you can do is just try and passively track the market. The extreme benefit of starting young is that most people actually don't need to beat the market. They can actually just replicate the market's returns and still be able to fund the financial life that they want in the future. From looking at a bunch of research, it shows that when you're younger, the best thing you can actually do is try and increase your savings rate by reducing your spending and increasing your income rather than trying to beat the market's returns. However, as you get older, trying to beat the market's returns becomes way more important. For beginners, the best thing you can do is just to try and passively track the market because A, you don't have the skills, and B, most likely, on average, you're gonna fail. I mean, if 92% of the professionals can't do it after 15 years, you probably won't either, myself included. That's not to say it's not possible, but it does take a lot of time and effort to do it. There are some legendary investors like Warren Buffett who can do it, but according to Buffett, the best thing that most people can do is just buy an S&P 500 index fund that tracks the US stock market. And another great quote from Warren Buffett is to smash the like button. Well, an ETF is an exchange-traded fund. It's essentially a basket of stocks that trades on a stock exchange. So instead of having to buy all the individual companies in the fund, you just make one purchase and you own a percentage of all those individual companies. It gives you the benefit of diversification and the ability to track the market's returns. There's some that track the US stock exchange, there's some that track the whole global stock exchange, there's some that track Asian stock markets. With this large range of potential ETFs to invest in, it can become extremely complicated to construct an ETF portfolio. However, at the same time, because ETFs can track the whole global market, it can also be very simple. So it's really up to you how many ETFs you want to have in your portfolio, and it's up to you how complicated or how simple you want to make it. To be able to actually invest in ETFs, you need to open up a brokerage account. Now I'm going to show you guys how you can find your own online broker. So all you have to do is search online broker for investing, and then you can put your country or your region. So EU. A good website is Broker Chooser, and they've done reviews on a bunch of different online brokers. So as you can see, there's a bunch of them, and you just have to pick which one is best for you. DeGiro is actually the one I use as well. It's cheap and it's simple to use. Interactive brokers can be a lot more complicated. It has more research tools, but they're both regulated, so you don't have to worry about them stealing your money. I know that is a question that lots of beginners have. So I personally use DeGiro, and their website is degiro.eu. As you can see, they have a bunch of different European countries here, and you just pick the one that applies to you. So whichever country you pick, that is the language. So if you actually want it in English and you're from the EU and you don't want to use pounds, you actually have to pick an Irish account. So I actually emailed DeGiro when I opened my account a year ago. They emailed me back and said, if you have a European bank account and wish for the language of the interface to be in English, we recommend registering an account on our Irish platform. You just click on open an account, you input all your details. Once you have your account, you just link a bank account to the account and you can transfer money into your account and start investing. So in terms of ETFs, the most important things that you can consider is the expense ratio and the assets under management. Essentially, you want the expense ratio to be as low as possible because then you're paying less of your assets each year and you're getting a higher return. Even a 1% or 0.5% difference because of compounding can lead to huge differences over 40 years. So expense ratios are important. And if you don't know anything about compounding, you can check out the previous video. And another important thing is you want to invest in ETFs that have potential to be open for a long period of time. So according to Just ETF, an ETF with over 100 million in assets under management is profitable and does achieve economies of scale for the ETF provider. So these ETFs could be a good option. If an ETF, however, does decide to close and you own it, you don't lose your money, you still get your money. However, at that point in time, you have to pay capital gains tax. Having to pay this capital gains tax can be a bad thing for the long term. Eventually you will have to pay it, but when you're starting out, you want to have as much money as possible compounding. And if you have to take 20-30% of that and pay tax, it reduces the money you have compounding. So essentially you want to find an ETF that has a low expense ratio and that has a good chance of being around for a very long period of time. Remember, this is not investment advice. I'm just trying to present you guys with a bunch of research and factual information, and you guys make your own investment decisions. I'm going to show you guys a really good website to do your own research on ETFs. If you're in the US, you're going to want to use ETF.com. These ETF websites are just a collection of all the potential ETFs you can invest in, and you can look at them based on different strategies and their expense ratios and assets under management. So you can look at that yourself and you can find ones that meet your goals for your portfolio. Just ETF is really the only one that I've found that works well for European investors. You go to ETF Screener and then you can choose what kind of ETFs you want. As you can see, there's ETFs for equities or stocks, for bonds, for precious metals, for commodities, for real estate, for the money market. So there's a bunch of different ETFs. If you want to find the ETF that just tracks the US stock market, you just click on equities, you go to country, you go to the United States. You can order these based on fund size, total expense ratio, and the last year's returns. If you have two ETFs that do the exact same thing, the one with the lower expense ratio is going to cost you less. Anything above 0.5 is considered expensive. Try and find it as low as possible. The major companies in the ETF market are iShares or BlackRock and Vanguard. And in general, you want to be investing in ETFs from the bigger companies because they're most profitable ETFs. They're very unlikely to be closed in the long run. So finding a mix of the fund size and the expense ratio is important. So if I search by total expense ratio, it shows the smallest ones first. As you can see, one of the cheapest ones has an expense ratio of 0.05%. And this is the Invesco S&P 500 ETF. And you see there's two versions. And this is because ETFs can either be accumulating or distributing. An accumulating ETF is one where the dividends that are paid are reinvested and used to purchase more shares of the ETF, whereas a distributing ETF pays these dividends out in cash. If you're invested in the S&P 500, there are going to be some companies that pay dividends and some companies that don't pay dividends. From the companies that do pay dividends, you can either choose to reinvest them or not reinvest them. Dividend reinvesting can be extremely advantageous for someone with a long time horizon, so it's best to look for an ETF that is accumulating. Because if you reinvest your dividends, you can supercharge your long-term returns. These dividends buy more shares, and then you have more shares later, and then they pay more dividends, and then you buy more shares, and it keeps compounding and compounding like that. There was a study conducted looking at the MSCI World Index where dividends were reinvested or not reinvested. When dividends weren't reinvested, $1,000 in 1993 turned into $3,321 at a 5.9% return. However, if you reinvested dividends, your $1,000 turned into $6,416 in 2018. So this is almost double just because you reinvested your dividends and got 8.3% return instead of a 5.9% return. So as you can see, this Invesco S&P 500 UCITS ETF, if it says dist, it means it's distributing. And in this case, it doesn't say anything. So you can just click on it. And we can see here that the distribution policy is accumulating. In replication, it shows synthetic for the Invesco S&P 500 ETF. The synthetic version means that they're using derivatives and forward contracts to actually track the S&P 500. In general, if you can, it's probably a better option to choose the physical version because you don't really know what's happening with the synthetic version. Think of it this way. If someone offered you the same meal, one was physical and one was synthetic, which one would you rather eat? Obviously the physical one. So do the same thing with your investing. The iShares S&P 500 UCITS ETF, this is a physical optimized sampling. So by optimized sampling, it means it doesn't buy everything, but it buys enough of the companies to actually return the market's returns. However, this one's distribution policy is accumulating, so we're going to want to use this one. And in addition, this is physical full replication. So full replication means that it has bought everything in the index. So if you click on listing, you can actually see the exchanges where this ETF is listed. You can choose which exchange you want, and then you can buy it on that exchange. If you look on this page, there's a bunch of different ETFs and different strategies that you can invest in. You can invest on a country basis. You can invest on different indexes. And as you can see here, there's a bunch of different indexes around the world, and you just have to choose one that fits your goals for your portfolio. It can be a bit confusing when you see all these different indexes I mean, there's a MSCI World Index, which is just developed countries, and then there's a MSCI ACII Index, which is developed and emerging markets. So it can be a bit confusing. You just have to do a bit of research on the index you want to track, and then you can find an ETF that replicates that index. So you can make your portfolio super simple and just choose to track the MSCI ACII Index, which is basically a representation of the global economy. It has developed economies and emerging economies. So you can see here that the largest ETF is the SPDR MSCI ACII one, and it's also the cheapest one. It's accumulating and it's also physical, so this is perfect for a long-term investor. So you can use just ETF to actually find the ETF that you want, and then once you're done with that, you can specifically go onto the company that provides the ETF and look at their website. So a good thing to do is check the investment objective. Is it what you want in your portfolio? So you can see that the iShares Core MSCI World UCITS ETF covers 85% of the listed equities in each country, with global companies in 23 developed countries. So it's a core portfolio to seek long-term growth. So this could be an option for anyone to add into their portfolio. You can also see the holdings of the ETF. So you can see that this ETF has Apple, Microsoft, Amazon, Facebook. These are the top 10 holdings, and you can see their weight. However, if you want to go through all of them, there's around 165 pages, so they have a lot of holdings, and you know you're well diversified. I would also recommend looking at the fact sheet so you can see what the ETF is meant to do, and you can see if it meets your own strategies. There's also the same for Vanguard funds listed in the UK. These are also listed on different European exchanges, so you could go on Vanguard as well. And as you can see, these use different indexes. They use the FTSE indexes, while some others use the MSCI indexes. Really, it's just there to confuse you, but you just have to sort of spend a bit of time, learn a bit about the different indexes, because there are some differences and some similarities between the two. So this is the ETF on just ETFs. I'm going to pick the Amsterdam Stock Exchange. Sorry to my Italian friends. So as you can see, the ticker is SWRD. I can go onto the Giro. I go into the search bar, I just search SWRD, and there it shows trackers ETFs. It says MIL for Milan Stock Exchange, or EAM for Euronext Amsterdam. So I'm going to click on this one. And then to make a purchase, all you have to do is click buy, select a market order, and input the number of shares of the ETF that you want to buy. Place the order and confirm. That's all I had to do, and you see it's already went through. All you have to do is when you receive your paycheck, the first thing you do, put it into your investment account, and then make the purchase of the ETFs that you want in your portfolio. So essentially, to summarize, here are the action steps that you guys can take. Open up a brokerage account, think about the ETFs that you want in your portfolio, and then buy the ETFs. Start saving more money so you can invest more, and just invest consistently in these same ETFs. That's basically how you build an ETF portfolio for the long term. Also, let me know in the comment section down below what ETFs you guys are adding to your portfolio, and I'll also list a bunch of other ones that weren't covered in this video in the comment section. Thank you for watching, and I'll see you guys next time.